Why the smart money is moving into bond right now. Why disinflation pump will turn into deflation dump. The stock market doesn't bottom before a recession begins. The bond market doesn't bottom before an inflation peaks. Learning from last year. One way to benefit from inflation out of control is by owning oil stocks. One way to lose money twice to inflation is by holding bond. First, bond value drops when the interest rate is raised up by the Fed. Second, the yield you are receiving is lower than the inflation you are experiencing. That's why Warren Buffett owns oil stocks and doesn't recommend bonds. Kathy Wood said we better hope that inflation continues to slow, as she is very bearish towards oil stocks. Most of her holdings did great in disinflationary times. She doesn't own any oil stocks at all. So she basically wants the same thing as bond investors. I do believe this year is for the bond investors. Why is the market suddenly going up just recently? Why this deflation pump will turn into deflation dump. Why the smart money is moving into bond right now. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? The reason why markets is going up right now is because Wall Street is preparing for the Thursday's CPI pump. Ever since last year's October, after the CPI number released, if it's lower than expected, markets will go up a lot because inflation has peaked. Most of the investors is trying to front run the CPI pump, so if this pump continues into CPI day, if we are getting what we expected, don't expect another pump. If they start to sell down the Dow, which they already started, then we have a lot of room to fall. Because the only reason these retail stocks crashing is because of recession. Macy's dumped some bad news on Friday evening. Management teams for public companies will sometimes think it's clever trying to bury bad news into a weekend in hopes investors will forget it before the opening bell on Monday. The lame tactic rarely works. So let's break down this textbook news dump Macy's pulled on Friday afternoon. Key management comment based on current macroeconomic indicators. And our proprietary credit card data. We believe the consumer will continue to be pressured in 2023, particularly in the first half, and have planned inventory mix and depth of initial buys accordingly, says Macy's CEO Jeff. With this earnings pre-announcement, Macy's essentially issued a profit warning for the first half of 2023, in addition to telegraphing a less than stellar holiday session. Inflation in discretionary retail, apparel, handbags, other accessories, shoes, home goods, and electronics probably ran 3% in Q4 2022. And they will finish the year running between 2.5% and 3% inflation. Why? We have oversupply again, like we have had for the last 40 years. We have rising interest rates reducing the demand for new mortgages, and new mortgages drive the sale of home goods. We are back to 2019. We have at least marginally rising unemployment and marginally falling jolts. Inflation in discretionary retail is dead. Lululemon forecast a decline in holiday quarter gross margins on Monday, as the apparel maker discounts more and grapples with higher costs, sending its shares down more than 9%. Stubbornly high inflation and the threat of a recession in the United States have resulted in a shift in consumer spending away from discretionary products. Apparel and sportswear companies to attract cash-strapped consumers. High-end clothing companies such as Lululemon had fared relatively well for much of last year. But an 85% jump in the company's inventory levels at the end of the third quarter showed that affluent shoppers were pulling back on spending. Looking ahead, we see dark clouds forming with difficult compares, peak margins, high inventory, and rising competition. Adding that the need for more discounts to get rid of excess stocks is likely to weigh on margins going forward. Lululemon said it expects gross margin to decline 90 to 110 basis points in the fourth quarter, compared with its previous expectation of an increase of 10 to 20 basis points. The reason Lulu fall 9% is because the valuation of the stock is still traded as a tech stock in 2021. Now the market has two options. Either S&P 500 is going up to meet with the Dow, or the Dow is coming down to meet with the Nasdaq. With Monday's close, it's interesting to see where the market has decided. It looks like TLT is outperforming the S&P 500. The Dow is coming down. Sadly, the bond market is in control. And soft landing is delusional. The difference between the yield on the 2 and 10-year Treasury notes is the widest it's been in about 4 decades, flashing a notorious warning of a looming recession and a possible sign of more pain to come for stocks. It's the steepest inversion since the early 1980s, and potential grim omen for the economy, as an inverted yield curve has been a notoriously reliable indicator of a recession in the near term. The central bank is expected to raise interest rates to 5.1%. tracking on another 75 basis points from current levels. But the 2-year Treasury yield, which is most sensitive to Fed policy, has been on the decline since early November, which could mean the bond market thinks the Fed is bluffing with its promise of more rate hikes. The bond market is discounting Fed policy that is marginally more restrictive than the end of 2022. And many investors will see this as increasing the odds of a 2023 recession. History supports their concern. Numerous Fed officials have repeated that they will hike more than the market expects and stay there longer. I don't doubt that unless something breaks in a major way. If the Fed gets in hikes in February and March, then the 3-month Treasury note will start inching toward 5%, possibly as soon as April. The Fed ridiculously kept QE going all the way to March of 2022 for no reason other than it said it would. Supposedly, that maintained credibility. They did not want to shock the market by doing something unexpected. Supposedly, that maintained credibility. Now, the Fed has promised to hike rates more and stay there longer. They probably will do so to maintain credibility. The Fed would have more credibility if it did not yap its intent to market Pavlov's dogs. Forward guidance blew up in the Fed's face, and I expect that to happen again. In the 7 recessionary episodes of the last 50 years, the U.S. stock market bottomed on average 12 months after the first Fed cut, 13 months after the trough in unemployment rate, after, not before. After, not before. After the Fed pivots, stocks will crash. Bonds like TLT will moon. That's why smart money is moving to bond right now. This is my client Teddy Eazzy's book, Wicked Pussy Perfume, and it is an erotic novel, this one. Such an awesome book. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.